Let's get right to the floor show. Joining me now, JP Morgan Asset Management Managing Director and Portfolio Manager, Phil Camporeale. You know what's really kind of surprising? In just this week alone, you see the enthusiasm about the end of the government shutdown completely dissipate. Fear enter Thursday, Wednesday, got the tech trade selling off, and then today things seem to be a little bit more copacetic.
And the S&P's unchanged on the week.
Unchanged on the week. Thank you for the perspective, Phil.
Yes.
What does that tell you?
I think it tells me that there is some nervousness around valuations. I mean, you have bank CEOs talking about valuations. You have Jay Powell, who should be focused on full employment and price stability, talking about stock market valuations. But I think let's go back to that unchanged on the week. This buy the dip mentality, Liz, I think is focused on the $7.5 trillion sitting in money market funds right now. I think that there's a lot of people just waiting for 1%, 2%, 3% to get in. We've seen it a bunch of times over the past couple of weeks.
They missed the 2.3% drop in the NASDAQ yesterday.
Right. And it just,
they're not getting off the sideline. They're too nervous.
On a dime. And Liz, there's no euphoria. Like when I look at the University of Michigan Confidence Index, okay? Do you know that that index is at the same level as it was in the great financial crisis of '08 and when we had 9% inflation in the summer of 2022? So again, the fact that there's so much cash on the sidelines and the fact that there's really no euphoria out there, I think that this is still a fundamental story to be long.
Okay, so what stabilizers do you see for risk assets that you can talk about to our viewers who might be a little anxious about what they saw yesterday?
So first is earnings. So I think there's some PTSD around the dot-com bubble, right? we make that comparison a lot. I mean, yes, that was 25 years ago, right? But I think there's still PTSD there. You are going to get hurt if you miss earnings. These companies have a huge hurdle to clear, and they've been clearing it. And if you look at Q3 earnings just in totality, NVIDIA's next week, I mean, earnings this quarter were exceptional. You had 80% of companies beat on earnings, average is about 70. By about 7% they've beat, and the average is about 6.
Okay, so you still like tech. You don't see anything excessive in the AI spending?
We do. So that's to be determined, but for what we know now, we think that this is, again, the third industrial revolution. Behind the industrial revolution, the internet and AI, and these companies have huge moats. So there will be no kind of reversion to the mean when it comes to margins. Like one of our big calls over the next decade is that these companies will continue to stay strong with moats around their balance sheets that will allow the S&P 500 to trade at 22 times.
You are overweight equities.
Yes.
You're overweight U.S. You still very much like emerging markets. You hate cash. Just as you said, it's just sitting there doing nothing.
Hate cash. Liz, do you realize that through October, cash was the second worst performing asset class on the planet? And there's $7.5 trillion of it sitting on the sidelines. Like I hear a lot, if I can get 4% risk-free, 5% risk-free, why would I do anything else? You should be doing everything else. And diversification, which is my thing. You know, I'm a balanced fund portfolio manager. A balanced fund is up 15. The S&P is up 15. The balanced fund has half the volatility of the S&P. Revenge of diversification is the story of 25.
So 5% versus 15%.
Exactly. And again, Liz, this shouldn't be, should I be in cash or should I be in equities? That's not what this is. It's a diversified portfolio versus being on the sidelines. And that diversified portfolio has really come back with a vengeance this year.
Phil Camporeale, good to see you, my friend.
Good to see you, Liz.
Thank you very much.